Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. The core pattern has driven this market higher since mid-July has been the July to November ascending triangle, currently at 23,610 to 25,195. I've once more highlighted the pattern in dark blue on my daily chart to aid in visualizing it. Whilst this looks like a good pattern, it has, for example, had the requisite number of touches on each side that is necessary. It still had some imperfections. Both the lower trend line and the flat overhead trend line had been breached. Most recently, the upper trend line. However, the breaches were repaired, and in the end, it has been a good pattern. It is noteworthy to mention that the overhead flat trend line is also the August 2011 high, and it has in part been reinforced by the nearby long moving average, currently at 25,860. In mid-November, the market broke up through the flat overhead trend line, punching and closing over both this trend line and the long moving average. We saw the exploitation of this move higher, with prices pushing up through and closing over the May 2011 high at 27,330. The April 2011 high at 27,950, and the recent 50% Fibonacci line at 29,470. I'd earlier given the potential size of the move higher from the ascending triangle pattern and labeled some detailed topside targets. Thus, we had a primary target in the 30,070 area and a secondary harder to reach target X in the 32,160 area. The primary target was achieved, but the secondary target X is still live. However, it is obviously harder to reach, and the initial rally after the break higher failed to reach it, with prices dropping, well, crashing more like. But, and it is an important but with no two consecutive closes below the key 25,195 flat trend line. Even now. I'd earlier been minded to leave the secondary target X at 32,160 on my daily chart, for now, and I stay with that decision. There is one other factor I'd like to discuss. I said 3 weeks ago, and I quote, we had another bullish factor late 2 weeks ago. That is now 5 weeks ago. It was a bullish bow tie formation of the short moving average, that's currently at 26,905. The short medium moving average, which is currently 24,070. And the medium moving average, that's currently 23,340. They all crossed over 2 Fridays ago, which is now 5 Fridays ago. Now, bow tie formations have 2 elements. The first is that the market moves in the direction of the exiting moving averages from the bow tie crossover. In this case, it was upwards. And that proved to be the case. The second is that between 15 to 20 sessions after the crossover, in this case that would be between the 25th of November and the 2nd of December, we ought to see the beginnings of the next major move. And it is usually in the direction of the moving average, or upwards as well. Thus, I would ask you to look out between those dates, especially to gauge what is happening. And that's the end of the quote. Well, we are just the other side of that special time zone now, and we have started to move up, at least until yesterday, when though we made a higher high, we ended up with an indecisive spinning top. Now, I could regard that action as a glitch, and normal service will be resumed shortly, with a market moving higher. However, I'm always curious as to why things happen. And the reason this happened is that the prices are approaching the 50% Fibonacci line of the March to July move at 29,470. This would be an obvious resistance, but you may argue that back in November, prices easily exceeded it. However, I would counter, look at the opens and the closes. We barely had any over the 50% Fibonacci line in November, despite the big ranges. And back at the turn of May into June, we likewise had opens and closes around this 50% Fibonacci line. And that was even before it existed. So, I'd pay special care to that 29,470 level, despite what the bow tie may say. And that is a mighty big say from me, given how much I like bow tie formations when they happen. LME 3-month zinc. The waste of time is over, and prices have decided last week to start moving higher. It took a while, but eventually they're broken, but since repaired big old 2015 to 2020 bullish Andrews pitchfork, which is highlighted in bright red on my daily chart, specifically the lower time, currently at 28.25, held up the market since late September until the immediate bearish incentive had enough, and we saw prices move up and away. Admittedly, the congestion between 27.91 and 28.25, that included the June 2021 low at 28.10 and the July 2021 low at 29.60, and also the August 2021 low at 29.17. Well, they all played a role in supporting the lower time and the market. They all helped. In the middle of last week, prices pushed up over the middle time, currently at 30.24. which is highlighted in purple on the more recent latent to May to mid-August bearish shift pitch hook, using it as a base late on in last week to push up over the flatlining medium moving average, currently at 31.15, but not as yet closing over it. We're in fairly free air now until the congestion at 32.01 and at the June 2018 high at 32.20. The 32.01 area is important, as if you look back at mid-November and early October, it has capped the rises, and we've seen subsequent moves lower. Now this may happen again this time, but I'd like you to keep an open mind for one thing. The action since mid-September today is reminiscent of a reverse head and shoulders bottom, with the neckline at the 32.01 area. If this is true, then we may know within the next few days and weeks, then it opens up all sorts of possibilities. I'm looking at you, I'm looking at you, the declining long moving average specifically when I'm saying this. Now, going out to the bigger picture, I feel obliged to mention again the March 2020 to June 2022 ascending expanding wedge pattern, currently at 38.96 to way up off the top of my daily chart. This pattern is highlighted in dark blue on my daily chart. There are some outlandish potential targets below for such a long dated and wide pattern. So to keep an element of realism in here, I would suggest only looking at just the possible primary market at target X for such a pattern. That's in the 25.45 zone below. This is one in the back of the neck, back of the diary actually, more than anything else, and to be reviewed maybe once a year or so. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.